Hi, everybody. It's Michael Farr, Hightower Advisors in Farr Miller and Washington, also from the Farrcast. This is a message for Farr Miller and Washington and Hightower clients about the Federal Reserve's upcoming decision next week, what's at stake, why it's so important, and why it's so hard on the part of the Fed to come up with a clear answer right now. There's a lot of political pressure, of course, on the Fed to go ahead and cut rates. There are certain economists who are also in favor of cutting rates and those who aren't. I'm going to try and break it down very quickly for you here today so that perhaps you might better see why this is so difficult at this particular time. Everybody's saying it's easy. This is not an easy decision. Let's start first by asking you to turn off your political ears. Please, got to turn off your political ears. I'm talking about interest rates and the economy and what really needs to happen for the economy. That's Jay Powell's job. That's a Federal Reserve president, a bank president, and a Federal Reserve governor's job to help manage the economy based on data, not based on any political bias whatsoever. There are huge political undertones and overtones, and I want to try and ignore both, if you'll allow me. So think that you are the chairman of the Federal Reserve. You're the chairman, and you are now responsible for making a decision over the world's largest economy, and it could well change the fate of the U.S. Really, if you really do something profoundly good or profoundly bad. Quite a responsibility. I want to show you a slide right now about GDP. And it's going to show you GDP growth. And over the past few years, we've had 3.2% on average GDP growth under the Biden years. That doesn't mean I'm giving President Biden credit for 3.2% growth. I'm telling you that that was the experience under the Biden years. That's not a pro or con President Biden comment. Okay, we good with this? Not having political ears on? Good. Look to the right of that chart. Those last two quarters, first quarter of 2025 and second quarter of 2025, show very different big green lines as part of the makeup of GDP, gross domestic product, for those two quarters. In the first quarter, you'll see that that green line is well below the line. And that means that there was a trade deficit, a big trade deficit, where we imported a whole lot more than we exported in the first quarter. We loaded up warehouses with pieces and parts and goods and stuff that we needed in production because corporate America decided that they didn't want to wait for tariffs to be enacted. So in the second quarter, where we had this great surplus, it means we didn't import. We exported, but we didn't import. And therefore, the stuff that was produced and manufactured was the stuff that was bought pre-tariffs in that first big down green line. The question then is, since some of those warehouses have had to be refilled and those stockpiles have been deleted, how much was added at prices that had to pay higher tariffs? How much? And if the automobile dealership, and think about automobile dealerships and how friendly they've been to you in terms of prices, how much they're willing to say, oh, shucks, yes, I'll take a loss now. You go ahead. I'll take another $1,000 off of that car. You ever heard any one of them say it? I haven't. So if they're going to pay an extra $1,200 in a tariff to get a car into this country, you don't think they're going to pass that along? They're going to pass it along. Jay Powell knows it, but he hasn't seen it yet. Jay Powell is in the position of making data-dependent decisions, not what they anticipate could happen at the Fed, but what they see happening in the data. And right now, the data are starting to tick up on the inflation basis, but not in any material way. In some parts of the data, the inflation stuff is ticking up. The economy is still fine. We are seeing slowing in certain areas of data, seeing some slowing. And that's the argument. Wait, we're seeing some slowing, so shouldn't the Fed ease because the economy's slowing? And shouldn't we have lower interest rates? If indeed higher tariffs are going to drive prices higher, then that will be inflationary. And the J. Powell Fed, any Fed, can't be in the position of lowering rates when prices are rising because putting more money into the system creates more demand and will exacerbate those rise in prices. That's it. Inflation is something that they really can't get back into the tube. They can fight it with much higher rates, but he doesn't want to have to reverse course. So that's it. That's why they have this great conundrum about whether they should or whether they shouldn't. So I think they're going to do a quarter of a point at this meeting. It'll buy them time politically. It won't make a huge difference one way or the other. It'll make a big difference to Wall Street because Wall Street wants cash. Wall Street wants to know that there's a trend. Wall Street wants to know that there are more of these cuts coming. So this particular statement that we will get on Wednesday afternoon at 2 o'clock, and this particular press conference with Jay Powell at 2:30 will be one of the most significant, I think, that we're going to see certainly this year and perhaps in recent years. If he indicates that they're going to have more future cuts, Wall Street wants to know how many. Wall Street wants to know how much. How low will you go? Think of the Limbo song. How low will it go? Wall Street will rally on more money. Whether the Fed is right or wrong, Wall Street doesn't care. Wall Street just wants more money. So stocks will rally. If Jay Powell says, we may or may not need to have further cuts, Wall Street's not going to like that. So he's riding a political horse as best as he can, I think. I've known him for years, and he's a very careful guy. I think if he could wait until December to cut again, he would, but we'll see. And he will look at the data. And my opinion doesn't matter. And Jay Powell's opinion to Jay Powell doesn't matter that much. He wants to see the numbers. And that to me makes sense. Let me just give you some little background as to why this is so important. Right now, the United States has $37 trillion in debt. $37 trillion in debt. $29 to $30 trillion in GDP. These are fantastically huge numbers that are almost beyond comprehension. They're so huge. But what that means is from 37 trillion in debt to $30 trillion in GDP, we have more than 120% debt to GDP. That's what we have. The debt is increasing at about $2 trillion this year. If we continue to increase our debt at $2 trillion a year over the next 10 years, that's another 20 trillion. That takes us to 57 trillion. The new bill, the big, beautiful bill, I'm not making a political comment, folks. There's a price tag. It's right around 4.2. So you get to that 57 trillion in debt, you add another 4. Very simple, without compounding. We're over 60 trillion in debt. GDP will not grow anywhere near that fast. Think again. I'm going to back out. This is why it's so consequential where these interest rates are and what happens with this economy. You're chairman of the Federal Reserve. You know that there's $37 trillion in debt, and the yield on the 10-year Treasury right now is 4.06, which means if you're the government and you want to borrow money, you have to pay 4%. What happens if rates go to 5%? That's a 25% increase from 4% to 5%. And you're already paying $1 trillion. It's actually $1.13 trillion to pay the interest on that debt. Debt service in this country is $1.13 trillion. You can see it here on the graph. The whole Defense Department budget, for comparison, proposed budget is $1.01 trillion. We're spending more already of our annual spending on the debt than we are on the country's defense. And the U.S. defense budget is still the highest in the world, bar none. These are very consequential numbers. But this debt number, if you've ever had a credit card bill at one of those 20% numbers that you didn't pay off and it kept increasing, you know it can get away from you. This can get away from us. We have to be careful. It's a crucial decision, and we need to get it right. I hope this has helped. I hope it helps understand why we all need to pay attention to what's going on with the Fed. And finally, the independence of the Fed is more important to me now than almost any other time. It can't be politicized. This is a crucial decision that can't be weighed to favor one party or the other. The only interests that need to be served by the Federal Reserve are those of the American people and therefore the American economy. Hope you have a great weekend. God bless you. God bless America. Never lose faith in this country. We're the luckiest folks in the greatest country on earth. Thanks for tuning in. For Hightower, for Farr Miller in Washington, I'm Michael Farr.